Guys, the 2026 federal budget has just dropped, and there's some pretty significant changes that have been proposed around tax, property, business, and investments that Australians should really be aware of. Now, firstly, and this is an important point, these measures are still proposed legislation only, and nothing's been formally passed. But for the government, they're describing it as one of the biggest tax reform packages in decades. So very quickly, let's break it down in plain English. No political nonsense or agenda. For everyday workers, there's a proposed $250 working Australian tax offset that should apply from the 1st of July 2028, alongside the already announced tax cuts over the next 2 years. There's also a proposed $1,000 instant tax deduction for work-related expenses for the 2026-2027 year, which is just aimed at simplifying smaller deductions and claims and reducing paperwork. So in theory, this will mean less collecting receipts in your glove box and less random screenshots on your phone. Whoop-de-doo. For business owners, there are a few measures that are probably going to get some attention as well, as they should. One of which is the $20,000 instant asset write-off is proposed to become a permanent addition from the 1st of July 2026. And there's also additional support proposed around government investments, startups, venture capital, R&D activity, and so forth. But realistically, where most of this conversation is probably going to sit is around property and investment taxation, and yet to be teased out as well. One of the major proposed changes is about negative gearing. From the 1st of July 2027, negative gearing is proposed to be largely limited to new residential builds only. Existing property holdings prior to budget night are proposed to remain under the current rules. However, established residential properties purchased after the announcement would generally no longer be eligible to claim these investment losses and offset them against wages or ordinary income. Instead, those losses would generally be carried forward against future property income and/or gains. The budget proposals also included issues to do with capital gains tax. Now, from the 1st of July 2027, the current 50% CGT discount is proposed to be replaced with a cost-based indexation model, together with a proposed minimum 30% tax rate on capital gains. In addition to, there's also proposed changes around discretionary trusts, with the proposed minimum tax being 30% tax rate on discretionary trust distributions from the 1st of July 2028. Although all of these inclusions and rollover relief provisions proposed around this as well. Now, regardless of where people sit on this politically, the bigger takeaway is probably this. The financial landscape is forever evolving. Tax rules change, property rules change, investment rules change. The people who usually do the best in the long term are the ones who are not reacting emotionally to headlines, but are the ones who actually try and get out and understand the rules early and adapt accordingly. We've actually put together a much deeper breakdown of the federal budget changes and what they may mean in practical terms. Now, for those of you that are already on our mailing list, this is likely to already be in your inbox, or if it's not, will be there shortly. But if you're one of the few people that are seeing this on social media and you want a breakdown, just comment breakdown below and I'll make sure I get a copy sent out to you. Hopefully this helps. Any questions, don't hesitate to reach out. All the best. Bye.